Hello, my name is Dr. George Mochocki, and welcome to Management 218 Corporate Finance. This is Chapter 1. You're taking me on an online class, a blended class, or a face-to-face class. This is just a supplement. We discussed this in our discussion board. We discussed this in our classroom discussion or in our article reviews that you're required to do if you're in a blended or face-to-face class with me. Okay, so Chapter 1. You've taken this class. Don't be scared. It's a quick overview. This course is basically going to be learning vocabulary and concepts and understanding what is actually going on. You will be doing homework, and like in this chapter, it's more of a definition. Chapter 1 is a recap of what you had in accounting 1 and 2. That's what chapter 2 is about. And this one talks about what you had in management 111 or introduction to business, talking about sole proprietorship, different partnerships, and the little stuff. So this should take me only about like 20 minutes. It's just a quick, it ties in from what you've learned and brings it into where we're at this point, so we have a starting point. And remember, in finance, when you're looking at numbers, remember, finance is trying to project what the costs are going to be in the future. Do I make a decision now? And one of the questions, why study finance? Or do I go forward? Do I build now or do I wait? Because it'll be a different administration, better tax thing, better interest rates, everything to do with the money. Like it or not, business, even your own life. Uh, is about the money to make your life and your family better. So think of the finance as how do I make the company better? And then when you're a financial manager, it's not only for the company, you have people and families that rely on you making those good decisions so the company is survivable, it's marketable, and it basically makes money so you could pay your employees and they bring back into the system. Remember, so when I'm looking at finance, I don't only look at the company, I have to look at external forces coming in and what's changing, what's happening with the economy. Whether you like President Trump or not, irrelevant. When I discuss President Trump, and here I'm looking at his business policies. This is what the environment I have to work at. He has other policies I may agree with, I may not agree with. I don't care. I'm looking at it right now from a business perspective. Understand that from a financial perspective. What's his policy doing? If he loses the election in 220 and is a Democrat, I may take a pause for a year, finance, and say, okay, what's going to be the policy of this new administration? Is it going to be more taxes? Is it going to be more regulations? Do I have to save more money to cut some of my profits? That makes a big decision whether I expand or not. Is the economy going to be strong or is the economy going to be weak? If there's weak, people are unemployed. If they're unemployed, that means they can't buy my product. So I don't have to go in a full production mode. I scale back down to take care of mine survival mode. When I'm looking about different, we're going to be talking about different financial cycles. So you as a financial manager have to look, am I in a bear? I mean, the finance market's sleeping. It's okay. It's not doing anything good. Or in a bull. Everything's going on. I can make money, but I can lose money the same way. Remember, that bull, he could have missed me or he could hit me. But it depends how I am as a financial manager. So finance is a little different than accounting. Accounting gives me the raw data. I step on a scale. This is how much I weigh. I go, oh my goodness, I got my body weight, the mass, all that, the new scale, right? And my dietitian is the finance person. She understands all those numbers, what it means, and now she's going to come or he's going to come and create a plan for me to be able to, for lack of better words, lose weight or improve my body mass or improve my overall health. Okay, so that's what financial managers are doing. Okay, so we're good at that. So that's why I think it's interesting. Accounting, I had to put in this ledger. I have to look at this expense. This is what do you call it? A revenue, or this is some of my profit, this is my gross profit, this is how much I pay for taxes, this is my retained earnings. Remember, these are all the terms you've learned that you do. This is my sinking fund, and not where I keep the money to pay off for my bond. So this all ties in. Now I'm looking at this. Now I have to bring this company, so I have enough money to pay my employees. I have enough money to expand. I have enough money to pay myself. I have enough money to pay the government. I have enough money to help the community that I operate in. All this is considered underneath the financial, so I have to know what I'm doing. Okay, that's why I enjoy finance. I play with somebody else's money, but if you're bad, You're out of a job, all right? And most of you are basically financial managers anyway. You're going to school, you got a family, or you're taking care of somebody, or you're taking care of your elderly parents, or you're taking care of your brothers, whatever, you know what I mean? You got your own kids, it doesn't make a difference. Or you're just taking care of yourself. How am I going to pay the bills? How am I going to do this? How am I going to go on my vacation? How am I going to buy this? What am I going to do this? That's what, do I borrow? Do I take money out? Do I take money out? Do I save money? Do I take another job? Those are all, is it equity? That means I have my own money, or is it debt? I borrow money out there. That's how I can finance my business. And then when I do take a debt, do I make more money than I'm paying the interest? So I'm making money on that. Okay? Okay, now we're going to talk real quickly. We already discussed this. So you already have my concept maps. And if you don't, sorry, let me go back in here. Okay? All right. Where's my line? There we go. Okay, now I'm going to make this a little bit bigger. So we talked about why I do finance. And those of you that know me, let's see, I go about 200. Okay, I have to make it a little bit bigger. I'm live. I don't edit. This is what you see, is what you get. Let's see how 300 fits. Okay, okay. So we talked about four types, or this is something you had in introduction to business. Sole proprietor and partnership, right? Sole proprietor, I'm my own business, okay. But the problem with that is unlimited liability. If my business can't sustain a lawsuit, they come after my personal asset. Partnership, I divide that liability. So I have two. I have more money. I have everything else. Again, remember, this is a repeat of what you had in introduction of business. So think about unlimited liability. Now you could go into an LLC, limited liability corporation, or in a corporation you have the main corporation, a C corporation, or you could have an S corporation, right? And they have different partnerships here, so that you could be taxed like a corporation, but it limits your liability. What they say, a limited liability only to what your business debt that came up to. So if it didn't do anything, any kind of debt, okay, you did all right, and you go under, no problem. Business takes care of it. It's just, I got nothing, I lost it all, but I don't owe anyone. But if I owe somebody else under these two here, the sole proprietor and a partnership, I basically they could come after my personal asset, my house, my car, and everything else like that. The other thing in the partnership, you have a general partner and a silent partner. Okay, so make sure you know those terms. Incorporation and tax. Implication for corporate entities. Remember, corporations, double taxation. What does that mean? The corporate pays all of the taxes, federal, state, municipal, anybody that they want. They pay all the taxes. They have money left over to give it to me as a shareholder or a stockholder, and I basically all the taxes are paid. I had to pay taxes on that because that's the profit from them. I say, hey, they paid for that. I was a part owner. Nope, that's what they call double taxation. Remember, the government gets its money from more fiscal policies, taxation. If it wants to control the fiscal policy of the economy, if we're in a recession, they basically don't want to raise taxes. People don't got no money. They basically want to lower taxes, okay, and lower the spending. When they had the money, they could raise the taxes to help because the taxes basically are to help the constituents in that district or in that nation, for lack of a better word. Okay, okay. So we have that. So financial manager. Let's see what we have there. Making investments. How do I invest that money in the future? Making decisions. Do I buy? Do I sell? Do I expand? Do I close down a plant or close down an operation because it's not profitable? Do I change my product line? Do I change my customers? Do I focus my niche on that? Managing short cash needs. I need the cash now. And how do I do it? I could turn in. We learned about factoring. That's basically taking selling my accounts receivable. That's a very liquid. Or I could take a loan out. You're talking about managing in cash. Or I could basically say if you pay me earlier, I'll take a 10% discount, knowing that my interest rate on the loan will have been 16%. So they give me the cash here. I don't have to take out a loan. I'm saving 6%, and I have the cash money. And there's a lot of different things we could do to manage this cash flow. If I know certain types of the cycle is slow, let's say I'm selling Christmas trees or something that's doing with holidays, it's more of a winter season. Or let's look at Dairy Queen. What do they do during the winter? A lot of people don't have a taste for ice cream or freezing. Ooh, you know what I mean? Heck with the ice cream. So Dairy Queen basically is their money is down, but they still sell some ice cream for parties or anything else, but not as much. But so they know they could sell so much at least to pay the rent and the heat, whatever. If they make more, that's excellent. But what do they do for that? They sell hot dogs. They have hot chocolate with ice cream in it. So they can still make it, but not as much. Or they put money away when they have a good season and put it for the slow season. A lot of construction workers, they do well here, and then in the summer they either go to Florida where it's warmer, or they just live off all that overtime here and have an easier winter. Okay? And that's what a financial manager is doing. And a lot of people do that. Only you're doing it for a larger company. You have to make those adjustments, the pro forma. You have to say, what's going to be my budget next year? What do I think my sales is going to be next year? What do I think my revenue is going to be? Who's the party? And are they going to raise taxes? President Trump going to lower taxes? Is they're going to still have a China war, a trade fight? No problem. It's trying to trade fight. Will it affect you maybe that much? It's basically it cuts into the logistics. They have to pay more of a profit. They probably raise it up. If they raise up too much supply and demand, capitalists may not buy it. We'll buy it from Vietnam. We'll buy it from someplace else. But as a business, I'm getting all my products, my company, when I say my company, my financial manager, getting everything from China. I'm going to say, oh, okay, this may go on a little longer. Trump, once he gets his mind on, he's going to stick it on it. Remember, I didn't care if it's Trump or anything. I have to see how the administration is doing it, and I, as a business, have to work around it to make my business profitable or great again. I want to be great. What the hell? You know what I mean? And the only reason I'm saying that is because that's what happens. Same thing with employees. They want how much do I have more money? If the company's profitable, I have more money. I could give them raises. If I give them raises, they spend more money in the economy, and the quality of life goes up. I'm tying this all in from the first chapter, the whole book of Intro to Business. I also teach that. Okay, now the stock market. Remember, you have the IPOs, initial public offering. We'll talk that later on. But that's basically the primary market. That means the money comes to the corporation. But now I've got the stock and I want to sell to somebody else because I need money. It's like I buy the house. I pay so much to the developer, $250,000 for the property. And now 20 years later, 10 years later, it's worth $1 million. And it's holy mackerel. Who gets that other million? Not the developer. I paid him. That's the IPO. The developer is on the secondary. I'm in the secondary market. So when the company needs another IPO, more initial public offering, either I take a loan or I sell more shares, they basically look at the secondary market and make the adjustments either through a stock split. And we'll discuss that later on. I'm just throwing this all information in you, what you're going to be covering. Okay, so we got that. Physical stock markets. You had the New York Stock Exchange and the Dow. New York Stock Exchange, America Stock Exchange, all right, and the NASDAQ is computerized, but listing standards and other financial markets are basically NASDAQ, let's say SP 500, Standard & Poor's on there. All right, so we have that. Okay, now financial cycles we talked about, type of financial institutions you want to borrow from. Are you borrowing from an individual? Are you borrowing it from a company? Are you borrowing it from a bank? Are you borrowing it from an angel investor? Are you borrowing it from another corporation? Are you buying stocks into that? All this, or do I take a loan with them? Do I take a long-term loan? Do I sell my accounts receivable? This is finance. Welcome to my world. This is what we're going to be talking about, and this is now look. When I'm looking for accounting, again, if I'm going for accounting, I'm going to open up my own business. Let me see. Here I go. Let me just bring this fit the man. I'm going to open up my own business, accounting. Good. You go on there. You're going to firstly you're going to have an accounting. You're going to have someone from going to say, okay, I'm an electrician and I do this. I understand the books and everything else. I use QuickBooks. In a small business, and another electrician. Next thing I know, I'm basically taking care of electricians and plumbers because I know the rules and everything else, and I got more than enough. But now when they're making that money, they're going to have profit. They're going to say, hey, what do I do with this extra money, Mr. Accountant? That's when you put on your financial hat. Now, this is very detailed. You know exactly here's the money coming in, here's your spending, your operation is good. That's accounting. Gives you all those things. But it's not changing anything. It just telling me this is what's happening. I go on there, my blood pressure. Why is it high? I don't know. I'm just doing the reading. And finance comes in there and says, okay, it's too high, it's too low. How do I improve on my cash flow? How do I improve on my debt to equity ratio? How do I improve on my liquidity ratio or my profitability ratio? All those are ratios. Numbers just tell me, like my heart. my blood pressure, where do I fall in, and how do I adjust it? That's finance, and that's the interesting in finance. So, but you have to understand the different business. So these two are a risk. You start off this way. You can start off your business right off the bat as a limited liability or an S corporation. You know, there's $150 to $200. LLC is a little bit more because you need some kind of written proposal and all that stuff. I mean, a formal contract, for lack of a better word. But you could get it on there's services out there. I think about like $800, and then I have to renew it every year for like $200 in the state of Illinois. It gives you your information operate as a business, and it gives you your federal ID number, so you don't have to give out your social security number. And that's just different ways. It also protects you as just what my business does if there's any kind of liability. All right. So again, welcome to this class. Let's see how many minutes I have. Hopefully it's under a half an hour. What do we got there? Oh, 15 minutes. We're doing pretty good. We covered everything else. So just a quick refresher. And so now you understand from a finance perspective, I'm the one who's going to start changing stuff, looking at different customers, buying different vendors, looking at the external forces, internal forces, looking at the financial, the three statements we need, my income statement, how much money got to come in, my balance sheets, my debt to liabilities, for lack of better equity ratios, for lack of better word, and then also my cash flow, my checking book, how much money I got coming in and how much money I could utilize. Because if I can't pay my bills on time, it basically I got late fees. If I got late fees, it changes my credit score. Remember, there's a different credit score for business. Similar, we'll talk about that later on. And then I got to pay more money. I pay more money for debt. Because then I may want to say maybe I bring more partners in. I bring a partner in. I have to follow their rules or bring them in. So that means I don't make the ultimate decision because my partner, he or she, has 30% of the business also, or as individual stockholders, stakeholders say, hey, wait a minute, let's go this way with the company. So you have to be able to do a good story and able to manage. But those are the decisions the chief financial officer does. As a small business, you basically put on different hats. And, so it's a little different in accounting. Accounting is basically the raw numbers. The machines tell me, here's where I'm at. Finance is how I change. I could go wrong. I said, cut this out. And all of a sudden, I got different issues. You know what I mean? But that's where you have to always be able to adjust it. And if you say, well, I'm not going to own my own company, you're going to be a manager. You have to do a budget. You're basically doing the same thing. How much money's coming in? How much employees they're going to have a raise? Could I have the same amount of employees, or get them to do more work? First, since I'm paying them more, expect a little more effort on their part, not the same status quo, or to give them some other kind of assignments to justify the pay, or do I replace them like you see McDonald's and everything else replacing them with robots or those touch machines? Then you got other issues. Are those machines dirty, filthy? Pretty soon they'll give me a glove to touch the thing. And that'd be another way for safety to concern instead of cleaning the things all the time. All right. So that's it. Again, finance is interesting, and I'm done. And we're done with chapter 1, and then we're going to do chapter 2. Is more looking at a lot of the ratios and statements. It's just a refresher. So if you just finished accounting, you should be good. Again, my name is Dr. George Mochocki. This is Management 218, offered by Harper College. You're taking me on a blended class, a face-to-face class, or another instructor is utilizing this for a traditional discussion. Right.